All right, time to get things started here. I'd like to take this opportunity to welcome everybody today to our earningsbeats.com top 10 stock picks sneak preview. It's May 18th. You got John Hopkins here. Tom Bowley going to be jumping in just a minute. Got a great crowd coming in today. And I was thinking about this just before I came on here, thinking that we are sort of when you talk about social distancing practices, that's what we're doing. That's right. That's what we're doing. And I'm thinking back to when Tom and I first started the company, started out as Invested Central back in 2004. And we did a lot of seminars where you rent a room at a hotel, something like that. People would gather. We get, big crowds. You'd throw up information on the screen, and just thinking that would be pretty difficult to do right now for a number of reasons. And actually turns out that, when we started moving away from the in-person events, that what we present sets up so well on the computer with the charts and everything else that we show. So maybe we were a little bit ahead of our time. It's turning out to be okay. In any event, it really is great to have you with us today. A couple of quick ground rules, if I may. Number one, this event, like all of our events, is being recorded. If for some reason you can't stick around for the entire session, you don't have to worry about it. We'll get you a recording. And something that Aaron has done, by the way, Aaron, of course, Weber, it's just, I can't tell you how important she is to this company, since she has joined us. A lot of things that she does in the background. She's our vice president of operations. And of course, Chris, my son, has been with us a long time. He does a lot of the background work too. So I just want to make sure, I want to shout out, for those two. But anyways, yes, it'll be recorded. And one of the things Erin has done is that she, when the recording is being prepared, she timestamps it. So you can, if you don't want to look at every section, you want to jump into a particular section that, or go back and repeat it, it's all laid out for you. So that's absolutely, I think, fantastic. If you have questions, it's very tough, for Tom during the event to stop. I'll answer as many questions as I can. If for some reason we don't get your question, you can always just write to us, go to our website, and make sure that you send us a note. We'll try to respond to you in a reasonable period of time. This event today is really to give people an idea of what we're doing tomorrow, because that's when Tom will actually unveil the top 10 stock picks for portfolios, 40 stocks in all. And he'll be talking about his methodology tonight. Tonight's open to the public. Tomorrow's a members only event. So if you like what you see and you want to get access to the top 10 stock picks, the 40 stocks tomorrow, you have to be at least a trial member. And I'm sure Tom will show you that we have our spring special going on. I think it goes until the 23rd. You can save a boatload of money and get everything that we have to offer. It's a 50% savings that goes till the 23rd of May. So make sure you consider that. Okay, there's a lot to cover, so I'm going to slip into the background, but I'll be on standby and available. In the meantime, let me see if Tom's ready to go.
I am ready to go, but before you walk out, I got to ask you a question.
All right.
We've been doing this for a long time.
Yes.
And I mean, how many times do we talk about options and options expiration and the impact it has? I mean,
a lot.
We've been doing this talking about it just about every month now for the last 16 years.
Yes, we have been. Yeah.
Now, you follow CNBC pretty closely. I mean, I never have it on. I mean, I cannot even tell you the last time I've watched CNBC.
I've got the volume down, but in the background in case there's breaking news.
All right. Well, how much breaking news was there on there today about options expiring?
Let me tell you something. I was going to mention that to you even last week, okay? everybody was trying to figure out what was going on with the market last week and then today. And there's not one discussion, not even one. I wanted to scream at the TV and say, hold on, let me tell you about Max Payne. Look at some of these stocks. Look at the indexes. Do you see what's going on here? There was not one discussion. Not one is the answer.
Yeah. I mean, I don't want to go on CNBC and tell anybody, to be honest.
Yeah, it is amazing.
I'd rather just tell our members, and everybody just keep quiet.
I'm hearing you. No, I agree 100%. All right, so I'm going to go ahead. I'm going to let you take over and have a great event here.
Yeah, I am almost floored when I'm looking. I'm going through all my charts right now. And, our Max Payne, we do an event. For those of you that are new to Earnings Beats, we have an event every month. It's the Tuesday before the monthly options expire. So it's our Max Payne webinar. And so what we look at are companies that have made big moves to the upside, that are heavily traded in options, because what happens is the masses get so excited about stocks. All they do is just buy calls hand over fist. And you got to realize, on the other side of the options trade, there's not always a liquid, someone selling. So you got a lot of market makers that are on the other side of these trades. So when everybody's jumping in and jumping in with both feet on the long side, you got market makers on the other side of the trade. And you might say, well, they're getting hurt as these prices go up, but market makers don't get hurt. They're on the other side. So they sell the call, and then they, for calls, and then they turn around, they buy the stock. So it's a covered call strategy. So if the price keeps going up, they're still covered, they're fine. But what can happen is these stocks, after, toward the Friday expiration, or maybe the beginning of the following week, these companies can reverse and come back the other way. And the thing where market makers, instead of market makers, maybe I should start calling them market manipulators. But the way these guys work is that they, if you buy a call, they can be on the side selling the call to you. So they're on the other side of that. And then they turn around and they buy the stock. Okay. So their long position makes money on the way up as the price of the stock keeps going up. Then if at some point, whether it's right before options expire or maybe even right after options expire, because remember, these options, if you're holding a call option, let's say you got a call option to buy Apple at $290 and the stock closes at $310 on option expiration, you have the right to exercise for $290. Of course, you're going to buy it at $290 when it's selling for $310. So you exercise. If you don't sell your call, you exercise. So for every contract you own, you buy 100 shares of Apple. Well, who do you think's on the other side of that trade? Market makers. So sometimes, even if a stock doesn't pull back into options expiration Friday, it'll pull back the following week sometimes. And that's why historically the stock market does not do well from the 19th of the month through the 25th. Now today was the 18th, but remember, this was the earliest that the third Friday can fall. The 15th of the month is the earliest it can fall, which means Monday, the 18th, is the earliest that we can have the first day after options expire. So now what I was seeing today, the market went crazy, but most of the stocks that have been leading this rally for the last 2 months struggled today. Not all of them went down, but most of them underperformed, and some of them couldn't catch a bid today, which, I'm just watching market makers shorting all of those stocks. And then because when they short, now they made money on the way up. If they short it on the way back down, now they're making money on the way back down on the short side, and they're wiping out the call premium. It's like, 1, 2, 3, win, win, win. And I've said before, market makers, I think, would sell their parents for $1 each if they could. I mean, they're in it for the money. And it's part of our system, but if you're not aware of it, you can really see a lot of whipsaw and be hurt by this around option expiration time. So that's why we have these Max Payne webinars the Tuesday before the Friday. Is really important. And I'm going to go over some numbers with you here in just a couple of minutes that are probably going to blow your mind. But let's go ahead and go through the agenda here real quick. I know we're getting started just a little bit late, but it just amazes me sometimes the amount of, the information that comes out and the coincidence of the timing of when it comes out. So I think, when I get up in the morning like I did this morning and I saw the positive test results from Moderna, I'm like, okay, there it is. That's going to flip the entire market, because what's been happening for the last couple months, and especially heading into options expiration, was all the companies that were, benefiting from stay at home, from social distancing. Those stocks have just been on a tear to the upside. Lots of net in the money call premium on those stocks. And then the companies like airlines and hotels and cruise lines and gambling stocks and many of those types of companies have been slammed to the downside, and everybody's been on the put side. And so it would behoove market makers for those stocks to rally. And so that's exactly what we did. It was a bifurcated market today for sure, with all of the laggards leading, and I mean leading big time. And then you've got all of the recent leaders, many of which couldn't catch a bid. And it just flipped like that. Just a switch just went off. So anyhow, we had pretty crazy action. I wanted to try and get the agenda up so I can go through that if I could. I don't have access, but Aaron, if you're there we go. Okay, so what I want to do is just go through a quick market update with you. Talk a little bit about this Max Pain. I want to show you some numbers. I mean, it's phenomenal what just transpired since Tuesday of last week. Talk a little bit about portfolio results and summary and where you can find that information if you're a member at Earnings Beats, and show you, if you aren't a member, if you become a member, it's really easy to go back and take a look at what we've done. Also, I want to go through sector and industry group relative strength. This is a key component of how I start to put together these portfolios, which will be announced tomorrow. And that all kind of falls into the portfolio design strategy. And then, of course, tomorrow is the big day, the quarterly draft. I always look at it like the NFL draft. I'm an NFL fan. I love sports, pro sports, especially football, pro football, college football. But anyway, I look at these portfolios as really, we've got thousands of stocks to pick from, just like NFL owners. And, when they sit down and do their draft, they've got all these college players to pick from. But the advantage we have in the stock market is we're not picking against anybody else. We can pick anything we want. It's not like, somebody else gets to go first and they take Apple, and then we have to, decide what we're going to choose. So we can pick anything. So if somebody else picks Apple, we can pick Apple too. So we have a huge advantage in our draft over what they have in the NFL. And, but anyway, it's kind of like that to me. Every 3 months, they do it once a year. We get to do it every 3 months and go through. And the reason it's every 3 months is because earnings come out every 3 months. You get, earnings and interest rates are the two drivers of the stock market. Those two factors are what drives the stock market. We have a Fed that is completely dovish right now. The Fed will do anything for stock prices. And you have to recognize that. You might fight it if you want. You might say, well, it's not right, but they're there. Don't fight the Fed. Everybody's heard that before. You don't fight the Fed. That's one part of the equation. The other part is earnings. We've got historically low interest rates. If companies can consistently grow their earnings with interest rates this low, their valuation, their multiples, price earnings multiples should be stratospheric. I've read so much stuff about, well, PE ratio now is at 20. Historically, that's too high. Well, when was the last time we had interest rates near zero? I don't think ever. My background, just for those of you who don't know, I was in public accounting for 20 years. I valued companies. I know how to value a company. And when you've got low interest rates, historically low interest rates, you're taking future earnings or future cash flows and you're discounting them back using market rates of interest. When market rates of interest are the lowest they've ever been, present values will be higher than they've ever been. That's the way it works. So when you hear people saying, well, the PE ratio compared to 1982 is, X, I'd be like, okay, well, what were the alternatives back then? Because that's what I would ask you right now. Okay, so you're not willing to pay 20 times the earnings for the market. where are you going to put your money? You're going to put it in a 10-year treasury yield and get 0.7% for the next 10 years, per year. Wow, great investment there. You don't have any choice. So these earnings are extremely valuable. These companies, when you look at some of the companies like Enphase Energy, ENPH, I just wrote about it, but don't ignore this chart today. When you look at these companies that are growing their earnings, or even if they have losses, you have to understand that when you come up with valuations, you're projecting these valuations into the future. When you start beating the consensus estimates, that raises your projections going forward. So, and it also builds trust. Wall Street begins to trust the management team. So you got a kind of a 1-2 punch that starts to build the valuation model. So I'm not buying into all of this where, this is the Great Depression. We've got a bull market and a bear market, and you've got to know the difference. The bull market consists of all these companies that are growing their earnings dramatically in a low interest rate environment. The bear market's comprised of all these companies that are trying to figure out how they're going to make it the next month or two because of all this debt, because, they can't get factories going. It's a diverging economy. And one or 2 days isn't going to change it. I know today was a pretty strong day for the weaklings and a not so good day for the groups that have been strong. But I can promise you that there is a major impact taking place right now because of options expiration. But anyway, going to get into all that. So tomorrow will be the draft, and we're going to talk a lot more tomorrow about the actual companies that are going to be in each of our portfolios. But I want to give you some information tonight that I think will be really useful for everybody. Again, especially if you're new to Earnings Beats. All right, so let me talk a little bit about the market today and the update. It was a strange day for sure. But let me go ahead and pull this up. All right, so I want to start first with the just the sector leaderboard. Now, one thing should stand out right away when you look at the top of the leaderboard. Look at the scooter scores for all of the sectors that we're leading today. Energy has a scooter of 14, industrials 19, financials 10, and real estate 20 or 25. Now, if you don't know what scooter is, SCTR, it's just an acronym, Stock Charts Technical Rank. This is a mathematical formula that was originally designed by John Murphy. And essentially, it's looking at how, in this case, ETFs are trading relative to other ETFs. So it's always in your same universe. It's large caps versus large caps, small caps versus small caps, ETFs versus ETFs, that sort of thing. So you can see, and it's on a scale from 0 to 100, or actually I think 0.1 to 99.9. Well, you can see energy, 14.3, industrial 19.1, financials 10.8, real estate 25. These are the weakest areas. These are the areas that have been beaten to a pulp in the past couple of months. These are the areas that have stocks where investors have been buying puts hand over fist for the last few weeks for sure. And as a result, it behooves market makers who are on the other side of these trades. They benefit as these areas of the market rebound around options expiration. So am I shocked sitting here looking at this on a Monday? Am I shocked that we had the positive drug news out on the vaccine from Moderna? I'm not shocked at all. In fact, I didn't know what the story was going to be, but just pick one and insert it, because that's what happens just about every month, especially when you're in a volatile market. When you're not in a volatile market, there's not as much money at stake. So this doesn't happen all the time, but when you've got a volatile market, it happens a lot more than you might think. And I'll never forget back in 2008, John and I, we were doing radio shows back then, and I'm pretty sure it was either October or November. I think it was October of 2008 when the bottom was falling out of the market, and the banks, Lehman Brothers, all this, and everything was selling off. And I remember John and I were on the air on Friday morning, option expiration Friday, and we were doing the show, and we're like, wonder what's going to come up. There's got to be something. And literally during the show, the Fed came out and announced some kind of a new thing that they were doing to it was, I don't know if it was TARP. I don't know what the heck. I don't even remember. It's been so long. But I know they made the announcement literally 30 minutes before the stock market opened on Friday that options were expiring with a ton of in the money puts. Kind of imagine, a couple months ago, March 23rd, that's about where we were back when this announcement came out in October of 2008. We had gone down 30% in 3 weeks. There was just a ton of in the money put premium out there. And then magically, the morning of Friday option expiration, the Fed comes out with the announcement. It was a rate cut, I believe, a surprise 50 or 75 basis point rate cut. And you might think, well, that was just coincidence. But, think about this. I mean, the government was bailing out a lot of financial firms back then. I mean, you had TARP, you had all these different things going on to help these banks. Well, one thing that would certainly help them without having to actually give them anything is just to make an announcement on a Friday morning. Because to me, that was another round of TARP and funding for many of these financial firms that had, not that they were going to lose money, because again, you can protect yourself, but they were able to make a lot of money. So they could have been protected if the market kept going down. They weren't going to lose money. I don't want to give that, I don't want anybody to think that, hey, these market makers are going to go broke because everybody's buying puts. They can protect themselves. There are strategies to protect themselves. But why not make money in every which way? And that's what they ended up doing then, and that's what they did again today. So all of the weak areas were areas being lifted, and then look at the bottom. Mysteriously, some of these groups didn't participate very well. Healthcare, communication services, this group's been on fire. Underperformed the S&P 500 today. Technology, consumer discretionary. All of a sudden, they've been hot for weeks, but today they couldn't catch a bid. Well, I shouldn't say catch a bid, but if you look at these, many of the stocks within these groups, even the ones that gapped up today, few of them kept moving higher. Some of them maybe trended sideways, and a bunch of them from the opening bell to the end of the day were selling off. And I can promise you, well, I can't promise you because I'm not there, but I have a pretty good idea that we had market makers that were on the short side, driving prices lower in a lot of these areas where the market had been very strong. So that was the first thing that kind of caught my eye. Then if we go back, let's pull up the industries. It didn't stop there, trust me. When you go into the industry groups, now if you're looking at the strength, check out the scooter scores. Now the best area of communication services was internet, 88 scooter score, barely budged higher today. Let's take a look at consumer discretionary. Recreational services, cruise lines. Wow. I guess everybody booked cruises today. No, they didn't book cruises. Again, market makers lifting the stocks. Down at the bottom, look at all the scooters in the 90s down at the bottom. Your toys, broadline retailers, specialty retailers, home improvement retailers, here's autos, recreational products. Just about all the strong areas of consumer discretionary didn't participate. The weak areas just shot up to the upside. Consumer staples, take a look. I mean, tires, scooter, 5. The lowest scooter score in the consumer staples, all of a sudden up 11% today. Coincidence. Energy, pretty much all the scooters are pretty low. Renewable energy is the best, but you can see all these areas pretty rough. All of them participated in a big way today. Let's look at the financials. Look at the scooters. The leaders had scooters of 14, 15, 16, and 13. The losers, 95, 85, and 83. All the best groups. Healthcare. Now, all of these groups are good, but the worst one, which has been medical supplies, was the only one really that participated. All the others, including biotechs, which have been the strongest, barely budged to the upside. And what's really ironic is it was a biotechnology stock that came out with the news that drove everything else up, but biotech didn't get the benefit of it, which I really found kind of fascinating. Industrials, airlines, worst group, up 14% today. It's a miracle. I guess they're all getting ready to, fly people around everywhere. Aerospace, 8.5 on a scooter. All of a sudden up 11% today, out of nowhere. Now, there's not a lot of strong industrial groups, but here, here's 87 scooter. Truckers actually have been really strong. Even today, I'm not going to complain about 5%. And even the worst industrials did pretty well. But business support services and industrial suppliers, two of the best areas, were at the bottom of the totem pole. Materials, aluminum, been absolutely horrible. Scooter of 2.7, up 15% today. The two great areas, miners, gold mining and mining, 99.9, 98.9, the only two areas of materials that lost. I think you're probably catching the theme here. Hotels and lodging REITs, real estate holding development, retail REITs, worst areas of real estate bombing it to the upside. And then the best areas, not really any good areas of real estate, but best areas lagged a little bit. And look at technology, computer hardware and software, two of the best groups in the market, barely performed today, underperformed the S&P. And then utilities had a pretty good day, and they've been underperforming with, you can see their scooter scores mostly below 50. So anyway, that's how the market reacted today. And if you listened to my show this morning, I said before the market opened, because one of the things we've been doing at Earnings Beats is we spotted a while back, and I'm going to show you some charts. And again, this is for those of you who have not been members or are not members of Earnings Beats, or not a member of Earnings Beats at this point. I want you to take a look at the spider. And when the market was going down, when the spider was going down back in March, look at the AD line, the accumulation distribution line, never put in a new low. So prices kept going lower. And when we first went down, you can see a big drop in the AD line. And then we bounced in price. We bounced on the AD line. But then when we went to all these new lows, we never broke below that initial low. And the reason was that a lot of companies, we were seeing gap downs, but then those companies were being bought. And when that happens, the AD line is similar to the OBV, on balance volume, except that the OBV is only looking at where you closed today versus where you closed yesterday, okay? So if you're going down, the OBV is going to go down by the amount of volume that's going down on that move. The AD line, though, is a little bit different. The AD line doesn't care what you did from yesterday's close. It doesn't even consider the gap. The only thing it does is it looks at where you closed within your day's trading range. So you could gap down and finish lower for the day. Like, for instance, right here at the end of February, this last February day, see how we gapped down? We finished at the high of the day. And look, all of this volume, because we finished at the very high of the day, all of that volume got added to the AD line. Let me show you what happens with OBV. And all of this, by the way, is going to tie into the portfolio, so just bear with me. I don't want to go into some things with many of you not understanding where I'm coming from. So, okay, so here's your accumulation distribution. See how we went up on that last day of February where we had this move here? And then the next day we had a really strong day as well. So 2 days in a row resulted in a big move here. Now look at the OBV. The OBV was going down and it kept going down. Why did it go down on that reversal? Because we actually closed slightly below the prior day. Not by much, but a little bit. OBV doesn't care how much you finished down or whether you reversed intraday. It only cares about where did you finish today versus where you finished yesterday. And if you finished lower, we're going to subtract all of the volume. If you finished higher, even if it's by 1 penny, we're going to add all the volume. I think AD is a much more representative tool, in my opinion. And you can see as the S&P went down, there went OBV for the most part right with it. AD did not go with it. So how does that matter? Well, you had to know some of the areas of the market, because many areas, as prices were going down, the AD line was actually breaking out to the upside. Other areas, while the market was going down, their AD lines were collapsing, indicating a lot of distribution. So let me bring up a couple of industry groups just to show you what I mean here. So here you can see software. Software has been one of the best areas of the market for the past, since the March 2009 bottom for the most part. But anyways, we went down here. You can see that initial move to the downside on the accumulation distribution. And then we bounced, got a little bit of a bounce here, and then prices went down. The software never printed a new low. We've just continued moving higher. We continue to show, in my opinion, accumulation. OBV kept going lower. So OBV was not sending that same signal. Now, let's look at a group that did not fare so well after these gap downs. Look at airlines. So airlines were moving lower, just like a lot of other areas of the market. But as airlines kept moving lower throughout March, notice the AD line kept going lower and lower as well. If anything, the AD line was telling us it was not good, even when we were holding on to support. Whereas the on balance volume right here, it's breaking out to a new high. Back when it was at 130 in middle of April, OBV is printing a new high. That was a horrible signal. AD line was printing new lows. That was the right signal. And you can see that airlines continued moving lower. So literally back toward the beginning of March, maybe it was the middle of March, we started breaking stocks down into 2 chart lists. And they're chart lists that if you're a Stock Charts member, you can download these chart lists right into your account from Earnings Beats. So let me see here. Just wanted to go back here. I don't know, I might have gotten timed out, but let me see if in the chart list page on our website, yeah, I got stopped out. Let me see if I can pull this up for you real quick. All right, so in the chart list page right here, you can see these different chart lists that we have. So we've got a strong earnings chart list. I'll talk about that more when I get into the strategy, because that really is one of the centerpieces of the strategy for the portfolios. We've got a relative strength industry chart list. We've got accumulation distribution chart list, ADCL. So this is relating to the accumulation distribution that I was talking to you about. So we have a strong AD chart list and a weak AD chart list. The strong AD chart list has companies on there that's been showing very positive accumulation distribution lines, what I was just showing you, and strong relative strength. They have to have scooter scores above 80 to get on there. So if you're on the strong ADCL list, AD chart list, you are one of the best performers relative to your peers, and your accumulation distribution line has been pretty strong. If you're on the weak list, it's the opposite. The weak list right now, we've got 268 stocks on here, 372 on the strong ADCL, 268 on the weak. And these are companies that have scooters below 20 and have weak AD lines. So you're going to see companies like the cruise lines and like the airlines and the hotels and so forth are going to be on this list. So for the last 2 months, we've been killing it. I mean, I'm not going to lie. We have been killing it. Strong AD has been amazing, because when you get these stocks that open lower, remember how that AD, I was just talking about this AD, it's calculated based on where a stock is relative to that day's trading range. If you've got a strong AD, and let me pull up something like, how about Teladoc? So Teladoc has been moving up. Now, Teladoc had a bad day today. Of course it did, because it's been a strong stock, and strong stocks didn't do well today for the most part. But Teladoc on the way up, it pulled back in March, just like the overall market, maybe not to the same extent, but it pulled back. But its AD line held prior lows and quickly just moved to new highs. So Teladoc, what this tells me, and if you look at this chart, you don't see a lot of red-filled candles, which means a red-filled candle is where the candle body, that rectangular part that's filled, that is the close is at the bottom of that filled candle, and the open is at the top. So a filled candle means you close below the open. A hollow candle means you close above the open. So as you go through and you look at a stock like this, Teladoc, if you're getting filled candles for the most part, you're going to see the AD line going up. So many times what's happening, like, look here, we actually had a big gap down on this, well, not a big gap down, maybe $3 on Teladoc on March 18th. But the stock by the end of the day was up $20 from the open. So when you see stocks on this strong AD chart list opening lower, if you go in, you pull up the chart and you like it, a lot of times these stocks were reversing off those morning lows. And so they were creating so many opportunities for us and for our Earnings Beats members. And the flip side is, if you're going to be on the long side, you don't want to touch the weak AD list. In fact, if you wanted to short, you want to go into the weak AD list. I mean, the week AD list is going to feature companies like Alcoa. Now today, look at Alcoa. It's been under a lot of pressure. Today, all of a sudden, it was, wow, 17%. All of a sudden, it's amazing. Look at the AD line. AD line's been horrendous. So, when you look, you don't see many hollow candles. You see a lot more filled candles, meaning that if you see any morning strength on a stock like this, you want to get the heck out. You want to short it. But what I said this morning during my Trading Places live show at Earnings Beats was that I would not pay attention to these two chart lists in the near term. And the reason being options expiration. I don't want to go against market makers. That's probably the best recipe to lose money in the stock market. If you find yourself battling the market makers, they are going to wipe you up for the most part. And so if you know that a lot of these stocks that are beaten up, that it would behoove market makers to bring these prices higher, I would not be shorting them, not yet. Now you get a stock like Alcoa, let's say it has another good day tomorrow and gets up to about 8.75, and then the following day, intraday gets up to 9.5 and then reverses. That might be the time maybe to think about shorting the stock again. Right now, you got to let this thing run. I would not be trying to step in front of the freight train. But that's the weak AD, strong AD, the opposite. So I want to talk a little bit about Max Pain because I'm going to bring up the charts, this chart list. This is another chart list that we did that members can just go in and click on and download. But here's the chart list. I'm going to go back over to Earnings Beats for a second. And so down here, you'll see May Max Pain. So all you have to do is click on this. And when it prompts you for a password, you just copy that, paste it. So I'm going to copy. I don't know if it'll prompt me or not because I've been into this before. No, I've already been into here before, so it's not going to prompt me. But if you click on it for the first time, it's going to prompt you. You just paste that password in when it asks for a password, and then it'll bring you to this screen. And now you're in your Stock Charts account. So you just say save to the chart list. Do you want to put it in a new list, merge with an old list, or replace a list? Well, just type in Max Pain May 2020, make it a new list, save results, and boom, it's in your account. Literally takes you, all the work I do, you can download it into your account in about 5-6 seconds. And that not just Max Pain, but it's the strong AD chart list, the weak AD chart list, the strong earnings chart list, and any other chart list we come up with. Recently we did a short squeeze chart list for members to keep track of for companies that are heavily shorted. But anyway, lots of opportunities to benefit here at Earnings Beats. And all of these chart lists I'm talking about, by the way, if you're a trial member, you can be a trial member for 30 days and you pay $7 and we'll even refund that. We just want you to try the service for 30 days. But as a trial member, you get you get access to all of this. The only thing you don't get is my relative strength industry group chart list, which is this one right here. It's got all 104 industry groups. And once you have this in your account, it doesn't change. All the other ones I'm talking about will change. So in order to get those in the future, you have to remain a member at Earnings Beats. This one, because you don't need to remain a member, we require an annual membership. And I'll talk a little bit about that later. But this is an awesome list. This just tells me on a relative basis which industry groups are leading versus the S&P 500. So all the charts in here are set up in terms of both relative strength and absolute strength. So here is, this is the hotel and lodging REIT, for instance, which outperformed the S&P 500 today by a mile. And you can see real estate, then you've got materials group, that's aluminum. Consumer discretionary, there's your recreational services. Industrials, there's your airlines. These are the ones that were outperforming today. Now, the other thing you can do is, well, what about the last 3 months? So if you type in 3 months, now all of a sudden you can see now we're back to gold and mining and gold mining. Broadline retail, biotechs, toys, specialty retails, truckers, pharmaceuticals, home improvement, all the areas that didn't perform today. These are the ones that have been leaders, but you wouldn't know it simply by looking at today's action. And again, you've got a lot of folks that have been buying calls in these groups. And so they didn't participate today. Don't read anything into that. That was, in my opinion, right now, this is nothing but a short-term phenomenon. I think we're going to go back to trading the way we were, but we've got to give the market maybe a couple of days to digest whatever it's going to do for options expiration. But I think we'll see a rebound in some of the companies that have been beaten up. So if you've been playing the Max Payne and you're in airlines right now, I'd probably stick with them at least for another day or two. You see a big reversing candle, I'd probably get out that day, or maybe just keep a trailing stop. I don't know, whatever, if you made 20% on an airline today, maybe putting in a 5-7% trailing stop or something, just to make sure you capture some, the majority of those gains, probably be a good idea. And then when you start building cash from that, then you can turn around and start looking at some of these other names, these good names that are being beaten up right now. All right, so Max Payne. There we go. So I'm going to pull this up in summary view. So summary view, you can see, first of all, I numbered these in order. So the first 4 were the ETFs that track the major indices. Those were the first 4 we talked about last Tuesday night. Any of these starting with 100 down to 118, these were all stocks that had been very strong. And if you notice, looking at the Spider, which gained 3% today, there were only a few of these that actually outperformed the S&P 500. For the most part, it wasn't that they sold off big, although Peloton, you can see had a big down day today. It wasn't that they all sold off big. They just didn't participate, and for the most part, underperformed. Now, down here at the bottom, starting with the 200 series, these are the ones that were getting beat up by the market, and you can see they were the leaders in today's rally. UAL, 21%. Southwest Airlines, 13%. L Brands, 17.59%. Boeing, 13%. 9% on AAL. These are annual returns that you could have gotten in one day. And if you look at these, like UAL, let me show you a 5-day chart, because this was last Tuesday that we had the webinar. So that would have been right here. So it wasn't like, Wednesday morning it started going right back up. It's just kind of an alert that, hey, these are stocks that potentially at some point are likely to get some love from the market makers. So we went down a little bit more than 24 hours, but from the low on Thursday morning, when we saw UAL go down to about 18.25, today we finished at 24.13. That's about almost 33% in just under 3 trading days. 2+ trading days. 33%. That's the power of following Max Payne, and the possibility. Now on the actual charts, what I did for members is I showed on here where the Max Payne levels were. So for instance, on UAL, Max Payne was up at 31. Now, does that mean that I think the stock's going to go from 21 to 31, in 3 days? No, I'm not trying to say that. Would I be shocked if it went from 21 to 31? I wouldn't. I'd maybe be a little shocked, but knowing what I know about Max Payne, I wouldn't be overly shocked. What I use it for more than anything else, and the way I always describe it is, for me, it's a directional clue. So if I know that a stock, if it behooves market makers to take a stock like UAL up, whether it reaches 31 or not is irrelevant as far as I'm concerned. But if it behooves market makers to take this stock higher, do I want to be shorting it? Not that I short in a secular bull market anyway, but no, the answer would be no. I would not be shorting, because I know it's in market makers' interest to bring the stock back to the upside. If I'm going to trade it, I want to be on the side of market makers, not going against them. Again, when you're battling the market makers, you are going to lose. It's, I don't know how to best explain it, but it's, maybe getting in the ring against Rocky, during the 1980s, Rocky was out. But that's, you're going to get knocked out. It's almost like the ending before it even happens. So UAL, big move up. But knowing that, I've already had members write in saying, the earnings beat service. This was incredible this week. If you played any of these airlines over the past few days, you have definitely done very well, much better than the overall market. All right, let's keep moving on. So let's talk a little bit about the portfolios, the results, and the summary. Let me go back into the website. When you come into the website as a member, you can go into the portfolios, and I'll just kind of walk you through it. Now, this was as of the close Friday. I can tell you that the model portfolio today, because I calculated it right after the market closed today, the model portfolio didn't have a great day. It went up maybe about 1%, something like that. The S&P was up 3%, so it fell a little bit versus the S&P, but it certainly had room to fall. Since November 19th of 2018, that's when we began the model portfolio, it's up 66.96% through Friday's close versus the S&P over that same time frame being up 6.43%. Now, as I wrote in one of the blog articles that I published earlier today over at Stock Charts, I read an article, I don't know, it's probably close to a year ago, that said that in the year 2018, 64.5% of mutual funds underperformed the S&P 500. I think they were large cap mutual funds, underperformed the S&P 500. And going back 10 years, I think the number was like 85% of mutual funds underperformed the S&P 500. And if you go back 15 years, look at a 15-year record, 92% of mutual funds underperform the S&P 500. So if you're somebody who puts money into a mutual fund, I would say you just buy the SPDR. It's very low cost, and it's going to outperform most mutual funds over long periods of time. The human element, number one, is a problem. Number two, you've got a lot of cost. You got salaries. You got all kinds of things going in to those numbers. Here at Earnings Beats, number one, the only thing you have is the membership cost. If our model portfolio beats by 60 basis points, you don't pay any more than you would if it beat by 2 basis points or percentage points. Maybe that's the way we should do it. Maybe we should charge based on how much it outperforms. Now that would be the first quarter the portfolios would go down. We'd be owing everybody. I like the way we have things set up. But my point here is we're doing something that most mutual funds can't do. Not only are we beating the S&P, but we've crushed it with our model portfolio. Now, this all started back in 2018. We actually did the strong earnings chart list. And when I go through the strong earnings chart list, I go through Zacks. I find companies that are beating top line, beating bottom line, trade enough shares so that they're liquid for our members, and then also are performing well technically on their charts, and they have strong relative strength. They have to do all of those things to get onto our strong earnings chart list. And as we go through earnings season, this strong earnings chart list goes up in terms of the number of stocks it has, and then it goes back down, then it goes back up, then it goes back down as we go through the heart of earnings season. So we had just recently 112 charts on the strong earnings chart list. I just updated it. We just put in a new one today for our members. We now have, I think, 272 or 273 charts on that list. We just added almost 200 based on all the earnings that have been out over the last couple of weeks. And so members came to me back in 2018 and they were like, well, you know, there's 250 stocks on this list. I don't know which ones to buy. You know, could you give me, you know, a handful or 10 of your favorite? And that's how the model portfolio was born. It's like, well, all right, let me take a look at the top 10, you know, 10 that I really like. And okay, well, let me go ahead and diversify. Let's make sure we get these in different industry groups. And then, you know, make sure they're equal weighted so that, you know, one stock is not carrying the whole load like the S&P 500. So we always make sure it's equal weighted at the start of every period. And let's just go with it and see how it does. Well, you can see these are the numbers. So it's done pretty well. Then we got questions in about, well, give us, you know, a lot of the model portfolio stocks have been mostly large caps. How about doing an aggressive portfolio? You know, give us some of your best picks in the small and mid cap world. And so on May 19th of last year, which will be a year tomorrow, we started this aggressive portfolio, which is made up primarily, not exclusively, because there are large caps that are aggressive as well, but it is primarily small and mid cap stocks. The thing that is unbelievable about the return on this group 22% versus flat on the S&P from a year ago. The most amazing thing is if you follow the market closely, you know that small caps and mid caps have been crushed by the S&P 500. Small caps and mid caps have been horrible. They've been awful. And yet our portfolio has been picking the best of this in this trash heap, and we've been performing leaps and bounds above the S&P 500. And most of this is this quarter. This quarter has been phenomenal for the small caps that we've got in our portfolio. The one stock I wrote about earlier today, Enphase Energy, and I talked about earlier, that's in the aggressive portfolio. Stock's up 55% this quarter. You get one or two of those in your portfolio of 10, and it makes a big difference. But there's your aggressive portfolio doing really well. At the same time, May 19th, we had a lot of folks that were retirees looking for income and maybe not wanting the aggressiveness of these other portfolios. And so they wanted to become more, they wanted to find stocks that are performing well on a relative basis, but pay dividends and maybe aren't as volatile. Well, unfortunately, this last quarter has been pretty tough because many of the areas that were represented in this portfolio were real estate. One stock in there that still remains a very strong relative performer is MAA. And it had, I want to say that one had like a 5 or 6% dividend, and it was a relative strength leader, but it didn't matter because real estate got trounced. So we want to be, we want to be transparent and honest. And I can show you when you go through here, down below, it shows each quarter. So if you want to come in and look and say, okay, what did you have in your model portfolio back in this first quarter? And what about the next quarter and the next quarter? And we've even got performance versus the S&P 500 for each quarter. So all of this is announced the day of the event. Just like tomorrow, we'll be announcing the stocks. 3 months ago, we announced these were the closing prices on February 19th. These are the stocks that are currently in our model portfolio. We've got Apple, we've got Amazon, Tesla, AMD, Google, Vertex Pharmaceuticals has been a great biotech stock. Shopify, what a monster that one's been. MSCI, which is in the financial area. Chipotle and Lululemon. Most of these stocks, if you're familiar with the market and trade a lot, you probably know. And they've been, outstanding. Their performance right now, well, through Friday, the group was up 4% this quarter. Through the pandemic, the group is up 4%. The S&P prior to today was down 15%. So you can see the massive outperformance this quarter by the model portfolio. So you can come in here and you can get an idea of our results and our summary. And again, you can go back to these individual stocks. You'll see what we bought them at to start the period, what we sold them at. Go back in and audit it if you'd like. But I think that this is, pretty indicative of the types of things that we've been able to do with these portfolios.
Hey, Tom.
Yeah.
One thing I want to mention on the income portfolio, because this question comes up a lot, that number you see there, that minus 4.79%, as far as I know, does not include any dividends paid during that. That's strictly the stock price, correct?
That is correct.
Yeah. So obviously, if you go back to the inception of 519 over the past year, stocks in that portfolio were ones that pay dividends. So I'm sure if you added the dividends back in, it would be even much stronger.
Well, yeah, it would be closer to the S&P for sure. I mean, most of these dividends have been averaging around 1.5% to 2%. The portfolio has averaged a dividend yield of 1.5% to 2%, and we've been doing this for a year now. So maybe 1.5% to 2% boost to this. It would probably still be lagging the S&P. But I will say this, the income portfolio actually was doing incredibly well until this quarter. And the pandemic, OMF, this stock has been hammered. MAA, that's the real estate company I was talking about, this stock has been hammered. Coke has not had a good month. And the home builders, Pulte Homes, starting to rebound now, but has not had a very good quarter. And I think Aon also kind of a rough quarter. So, yeah, I mean, there are reasons for it. But it's like any portfolio. It's like any mutual fund. I mean, some of these are going to have good quarters. Some of them are going to have bad quarters. It's really what you do over a period of time. And I think for the most part, these have done really well. Now, this last portfolio is one we started in November of 2019. So this is only the second quarter. we started it the first quarter. What we were doing was we were trying to catch stocks that had been downtrending, but came out with an earnings report and appeared to be doing some sort of a breakaway gap. So it'd been downtrending and all of a sudden came out with a great earnings report. It gapped up. And so we started putting them into what we called the character change portfolio. And we put 10 of these in here. And I'll be honest, the first quarter, they weren't impressive. They were down probably 8-9% versus the S&P 500. I can tell you how much they were down. Yeah, the S&P was up 8.5%. Character change portfolio was flat. So it was down 8.5%. This quarter is a little bit better. I think even with today's action, we might have passed the S&P 500. I know a lot of these stocks were having super days today. Many of them up, 10% or something. So I think they may have passed the S&P for this quarter, but I'm actually not overly interested in this portfolio. Just the performance has been a little lackluster. I'm eliminating this for this quarter coming up, and instead we're going to go with a strong AD, strong accumulation distribution fund. We're going to start a new fund, a new portfolio, and it's going to come off of that strong AD list. So the one difference between the strong AD portfolio and all the other portfolios is that the strong AD portfolio will not require revenue beat and an earnings beat. It's not coming from our strong earnings chart list. It's coming from our strong AD chart list. Okay. So that's going to be one difference, and I'll make sure that that's clear tomorrow when I'm talking about it, and also in our future weekly portfolio reports that we issue every Sunday. The model portfolio, the aggressive portfolio, and the income portfolio, every stock that's been in these portfolios, and the character change portfolio up till now, every stock that's been in any of our portfolios up till now has come off our strong earnings chart list. So the beauty of this, and I don't know too many companies like us that do this, is we like to combine fundamentals and technicals. Some just like to do technicals, some just like to do fundamentals. I think they're missing the boat. I think it's the combination of the two that drives equity prices. And I think we're in a unique position to help folks because, number one, my background is in public accounting. I was in public accounting for 20 years. I audited companies. I valued companies. Have a pretty good sense of the fundamental side. And then I can combine that with my technical side. And I've been practicing technical analysis since back in the 1980s. I was actually hand doing charts of the Dow Jones components back in the 1980s. Every day when I'd go into work, before I would start work, I'd get there 30 minutes before, and I would do a little bar chart on an accounting spread, like on a ledger pad. That's how nuts I am. What a geek I am. But I've, Chip Anderson, president of Stock Charts, I've kind of joked with him before that I had the idea before he did. I should have had stock charts. I was doing them. I was doing the charts before he created the company, probably about 15 years before he created the company. So I like the technical analysis. That's my real passion. And I've just happened to have the accounting background as well. So I think what we offer is better than other services simply because we're taking that two-pronged approach to everything that we do here. But I do want to mention the strong AD chart, or the strong AD portfolio going forward will not require earnings and revenue beats. Some of you may not like that. I just want to see how it works because I've been watching our strong AD chart list killing the market. So it's like, wow, if I could take 10 of my favorite stocks off of this, maybe we'd have something. So that's the idea, is to just continually evolve our service at Earnings Beats to try to find the best ways to outperform the S&P 500. And I think that's one that we should be looking at. Okay. So that's portfolio results in summary. Now, sector and industry group relative strength. I showed you this briefly, but I want to talk about this a little bit more. So when I'm looking at this, I could go back and look at the 3-month and pull these up. What I'm going to end up doing literally is putting them in order. And so I've got them in order. 001, all the 001s are technology industry groups. So I've got 001, XLK, all of these are 001, XLK, and then I've got 1 through 7 here. I've just got this so I can organize it in my chart list. And then here I've got the actual industry groups relative to the S&P 500. So what I'll do, and what I'll be doing tomorrow and tonight, is going through and really finding out where I want representation in the market as we go forward the next 3 months. So I'm going to look at computer services, for instance, and this is how computer services has been performing versus the S&P 500 for the last 3 years. Now, our goal is to outperform the S&P 500. The best way to outperform the S&P 500 is to find sectors, industry groups, and stocks that are all outperforming the S&P 500. You want the best stocks in the best industry groups in the best sectors in order to try to outperform the S&P 500. And some might say, well, yeah, but you're not going to be in energy, or you're not going to find any material stocks, or you're not, what about financials? What if they bounce back? Well, I'm not putting these together looking for bounce back candidates. I'm not putting these together looking for value. I'm putting these together based on strength, relative strength. So I want companies that Wall Street loves right now. 3 months from now, maybe they won't love them as much. So we're going to probably have some losers in our portfolios. But up till now, the reason why we've been able to outperform over the longer term is that we have these winners among our relative strength leaders in these portfolios. When you get an ENPH that goes up 55% in a quarter, or you get EHTH, which in our first quarter of the model portfolio back in 2018, EHTH went up 84%, I think, in 3 months. I mean, that's one stock. If everything else is flat, 84% for 10 stocks would still be an average of 8.4% for the entire portfolio. So if you get something, now that's been the best one. I'm not trying to say we're going to have another 84% winner, but if you get those types, we've had, 30, 40, 50% winners that help lead our portfolios. And so that's the idea, is you want to get 10 leaders in 10 different areas, mostly leading areas, industry groups. I will say, we make exceptions from time to time. Restaurants weren't looking great going in the last quarter, but I still went with Chipotle because Chipotle has been such a great stock within the restaurant group, and it's continued to outperform the S&P 500. So I want it in my portfolios. I think it's been in the model portfolio, or maybe might have been in the aggressive 1 quarter, but it's been in one of the portfolios, I think 5 of the last 6 quarters. And it'll probably be in the next one. I'm not giving away any secrets just yet, but Chipotle breaking out to an all-time high, it still looks really good. So there's a good chance you might see it represented somewhere in the portfolios. But as I look at computer services, do I want to own stocks in computer services? I mean, we've seen a nice little bounce here on a relative basis, March into April, but we quickly went back below both the 50-week moving average and the 20-week moving average. This is a relative chart. So this is a 20-week kind of relative moving average, 50-week relative moving average. The weekly relative PPO still below the 0 line. Is this going to be one of the best areas? No. Chances are, unless I find a computer services stock that's just knocking the cover off the ball, just crazy outperformance, probably not going to see a computer services company. And then I just go to the 104 industry groups. This is one of the first steps that I'll do when I'm designing. So I'm kind of stepping ahead a little bit, talking about portfolio design a little bit here too. But next up, semiconductors. Now look at this chart on a relative basis. Semiconductors for now over a year have been going straight up relative to the S&P 500. So do you think it might be a good idea for us to have semiconductor stocks in our portfolios? I would say absolutely. Semiconductors, you will see them. You might see one in each of the 4 portfolios, but definitely you will see semiconductor stocks being represented. Software. There aren't many better areas in software. Clearly, you're going to see software. All right, now we've got electronic equipment. We've seen a little bit of a move back in April, but this is not, we've seen this before. You get these pops and then come right back down again. It's not showing consistent strength, so no, I'm not going to be interested. That's a little enticing, but you've still got the 20 below the 50, still in negative territory on the PPO. I need more strength there. How about computer hardware? Apple's been in our portfolios for the last couple quarters, maybe 2 or 3 quarters. And I see no reason that we wouldn't want to continue to have computer hardware stocks. Looks really good on a relative basis. And then we've got electrical components. Well, we're just down at a multi-year relative low. I have no interest in this group. Telecommunications, again, this one was really strong for a while, but the last year, it's been in a downtrend. 20s below the 50, it's kind of rolling back over. Again, maybe if I see one stock that looks excellent, it could go into the portfolio. I'm thinking like a Ciena, CIEN. If I pull that chart up, I know that one's been really strong, breaking out again today to a new high. Look at the weakness back in March, moving lower. Look at all these hollow candles I was talking about. Look at the AD line moving higher. There was accumulation taking place back then. This wasn't distribution. This wasn't a sell-off that was going to lead to further selling. There were institutions accumulating Ciena back then. Now we see why. Stocks breaking out to a 52-week high, while the market's still, S&P still 400 points away from its high. So Ciena, even though it's in a group that maybe isn't the greatest, this is a really nice looking chart. So this one would certainly be considered. So again, that's what I do. So that's the technology. So I just did the technology view for you. The other thing that I would do is look at the relative strength of sectors. I can tell you that our portfolio, getting back to that question on energy, let's look at energy relative to the S&P 500. All right, now looking at this chart, energy relative to the S&P 500, what do you think your chances are of outperforming the S&P 500 with energy stocks? I would say probably not very good. And you might point to this and say, well, yeah, but it's bouncing here. Well, it's coming after a near collapse. It's this could just be a dead cat bounce, relative bounce. I'm not an energy fan. I think that there's still, it got beaten up so much. We had crude oil prices go negative, for goodness sakes. The supply demand issue was just completely out of whack. You could be paid. They would pay you to take crude oil and put it in your swimming pool, and store it for them. That's how crazy energy got. But the other thing you have to understand with energy and with materials is if you go back 10 years, look at energy for the last 10 years. We've had periods where we've had pops. Look at that nice little pop, lasted about 2 months. I mean, if you could time it perfect, if I could have gotten into this a month ago or a month and a half ago, yeah, I would have done really well. But the overwhelming trend here is to the downside, not to the upside. So I don't see a reason to go rushing into energy. And we've, for the most part, stayed away from it, other than just a couple of renewable energy stocks. And I think we had Murphy Oil in, and it might have even been in that character change portfolio. And that was one of the stocks that did well for us for a short period of time and then got slammed. And it was one of the reasons why the portfolio underperformed. MUR is the ticker. But that would have been last quarter that I think we had that one in there. So no, I mean, the other thing you have to understand too is that energy relative to the S&P 500 goes down when the dollar is rising. And if you look at the chart of, actually, I don't want to put it there. Let me put it down here. Oh, I already have dollar on here. So here was the dollar back in 2011. You could draw a trend line connecting that low, 2014 and 2018. We've got an uptrend in play on the US dollar. When the dollar uptrends, energy underperforms. That's been the history. Same thing goes for materials. So here's the dollar index on materials, or here's the dollar index rising, and then here's materials. Last 3 years, we could stretch this out. And over the last 10 years, you can see since 2011, materials have been underperforming. So do I want to try to put material stocks in hoping that the next quarter is going to look like this? Or should I be more concerned about the entire period looking like this, down, mostly down? What if I get in and I get in during one of these periods where materials just getting absolutely hammered to the downside? That's going to kill the portfolio. So I'm trying to put together a portfolio of stocks that are going to help lead and beat the S&P. So energy and materials, you're not going to see them in there unless maybe You might see a renewable. You might see ENPH in one of them. You might even see like Solar Edge, SEDG, another really nice looking renewable energy stock. But for the most part, you're not going to see materials and energy stocks in here. How about utilities? Surely we can find some really good utilities. Well, you know, kind of goes sideways. Again, we're looking for, you know, outperformance. Utilities have really been getting hit over the past couple of months, relatively speaking. This doesn't look anything like technology or healthcare, which I'll show you now. Here's technology. Yeah, if technology is going to do that to the S&P 500, we might want to consider semiconductors. We might want to consider software, computer hardware. Those are the areas. So we've got the best sector. Those are the 3 best industry groups. And then I'm going to go within those industry groups and find some of the highest scooter ranked stocks, some of the best relative performers. Those are the ones that are going to go into our portfolios. Let's see, what else? How about, I mentioned healthcare. Let's pull up the healthcare relative. So healthcare, think you might want to have healthcare? I'd say yes. I think healthcare, I think when we broke this right here, and you can see now that this relative line is above the 20, which is above the 50. The PPO is very strong, very positive. Yeah, I want to be represented by healthcare. And, you know, when you look at healthcare, if I go back to the industries for a minute, and let me pull up the healthcare down here. One area that I love, I've been writing about it. If you've been reading my blog or if you're a member of Earnings Beats, you certainly know about it. I love biotechs. Love biotechs right now. They've broken out over long period consolidation. They've broken out on an absolute basis, not just a massive move to the upside in relative strength, but they've broken out on an absolute basis after 5 years of sideways action. So if I pull this up, go back 7 years, here was the move. And then literally with one exception right there, for the most part, since 2015 through 2015, we had equal highs with just slightly higher break to the upside, but basically equal highs and higher lows off of an uptrending. I'm going to go back even further so you can see that prior uptrend, because when biotechs lead, it can get really exciting. Big move up, and then we pulled back on a relative basis. Here's your big move up, absolute. Sideways, this is a bullish ascending triangle that we just broke out. I think biotechs are going to be one of the leaders. So do you think that's going to be in our portfolio? I can guarantee you. I would say that probably without a doubt, you will see a biotech stock in each of the 4 portfolios tomorrow. What else? That's probably about it. So, I mean, I kind of already gone through, but as far as the portfolio design strategy goes, it all starts really with going over to Zacks.com, and I do a lot of homework. So if I go over here, let me just show you what I do. I mean, we do all the homework for you. That's the beauty of what we do at Earnings Beats. If I had to do this for every single member individually, this would be impossible, but it's scalable. I can do this one time. It takes a lot of hours, but then our members can come in and download all of my homework. Everybody can download it in 5-6 seconds. And that is pretty powerful. So what I do is I go into the earnings releases. And so just to give you an idea of what I just did over the past couple of weeks. So I went in here and let's just go back to, well, let's go into April. Wednesday, Thursdays tend to be the really heavy days. So let's just show you on April 30th, Thursday, 329 companies reported. Now, just think about that for a second. You're going to review 329 companies. If every member of Earnings Beats had to come in here and do this, imagine all of the hours that would be spent, not for the whole quarter, but just on this one day, looking through 329 reports. I've got it down to a science, and I can go through it pretty quickly. But what I do is I go into the sales surprise, and I look at companies. Apple beat on the top line. All right, come down the list. I'm just going to point out some obvious ones. Amgen, biotech stock. I love Amgen. Amgen. There's Amazon on assignment, or is that well, maybe it's, I don't know what that one is, ASGN. Let's see what else. Bandwidth. This is one that absolutely exploded after its earnings. This was on our strong earnings chart list. This is a company that might find its way into the aggressive portfolio. I'll show you that chart in just a minute. But if you go over here then on this earnings side, now I'm looking for positive earnings. That was positive sales. This is positive earnings. You can also get, you know, misses on the sales and earnings side if you want. But now as I go down, there's Apple. Okay, so Apple was on the revenue and the earnings side. So that one, I'll then look at the chart on Apple. Well, I already know the chart on Apple, so it's a good one. I know that one's going to be going into the list. And then, you know, you keep going down the list to see what there's Amgen. So Amgen beat on the revenues, beat on the earnings. That's on our list. Notice Amazon's missing. Amazon missed their earnings. So Amazon's not going to be on the strong earnings chart list, but Amazon has a strong AD. So there's a chance you're going to see Amazon as one of the 10 stocks on the strong AD portfolio, because that one's not earnings dependent. That you don't have to beat revenue and earnings. Okay, so that's how this is going to unfold going forward. There's Bandwidth, B-A-N-D. Earnings came out 4 cents positive versus the estimate of minus 11 cents. When you get companies, and I talked about this earlier in this webinar, when you get companies that are beating their estimates by this amount, 15 cents, going from an estimate of minus 11 cents to a positive 4 cents. If analysts are then raising their estimates going forward, a company like this can see its estimates, its target being raised very rapidly, and it can command in a low interest rate environment a huge PE. What are you going to do? Trade this stock at 10 times earnings at 4 cents? So should it trade at 40 cents? Of course not. You know, a company's rapid grower. I mean, you've got to build in the future growth. You know, a lot of folks just look at a stock, oh, its PE is 30. It's too expensive. Well, this stock probably is going to have a PE of 1,000 maybe. I mean, I don't know what the PE is going to be, but it needs to be a high PE because the stock is growing so fast in a low interest rate environment. So let's go over and take a look. So that's what I do every day. I'm going through this. So just imagine going through all of these stocks, every one of them, not just the ones that you recognize. I go through every one of them. So even the ones you don't recognize. That's why I know just about every ticker symbol in the stock market, because I've been doing this exact thing since 2013. I've been trading personally out of the strong earnings chart list almost exclusively now for 7 years. So it's not like I'm just throwing stuff out there that I don't do myself. This is how I trade. And being able to take all of this information, putting it into a chart list, and I'm going to give stock charts kudos, because when we started doing this, and as many members know, when we first started sending out chart lists to members, we had to go in. If I wanted to send the Max Pain candidates list to members, I had to go into the edit list. I had to click send a friend, and we had to get the personal user IDs of every Earnings Beats member. We had to get their IDs at Stock Charts so that we could send them the chart list one at a time. Talk about boring and cumbersome. And I give Erin kudos as well. She is detail oriented. I know she's my daughter. I have seen her in action for a lot of years. I know how detail oriented she is and what a perfectionist she is. But to sit there in front of your computer and send out a chart list to every member at Earnings Beats, first of all, we have to get the IDs from everybody. I mean, just imagine the nightmare of putting all of this together. And oh, by the way, we don't just have one chart list. We have probably 6, 7 chart lists now that our members have. So every one of these individual chart lists would have to be sent out to members one at a time. It was just crazy, the amount of time going in. So the reason I'm giving stock charts the kudos is we don't have to do this. Now what we do, as I showed you, is we can go in here and under chart lists. Now what Erin does is she puts in a link, and you click on the link and put in the password, and it goes into your account. We only have to put the link one time onto the website. So me doing all this homework now is really worth it for me personally, because I know all of our Earnings Beats community can get this literally in seconds once I'm done. So strong earnings chart list. If you're an annual member, you get the relative strength industry group chart list that I was just showing you. That's how a lot of this is put together.
Hey, Tom.
Yeah.
Sorry, I'm sorry to interrupt, but somebody asked about the webinar special. So just before you get off to the next subject, just make sure you show the special.
Yeah, I will. Absolutely. I want to make sure. I mean, we haven't run a 2-week special like this ever. At least I don't think we have. And so I definitely will go over that for, if you're new to Earnings Beats, you've got time to experience the service and check it out before you'd have to make a decision on the spring special, but I'll go over that in just a minute. But here's your accumulation distribution chart list. So literally you can click on this one. And if you're an annual member, this one, or actually, no, we don't have the list on here because obviously we have to make sure you're an annual member. So you email us and then we'll send you a link password so you can download that one. The AD chart lists, both the strong and weak. All the portfolios, I forgot about those. So once I have the portfolios, we'll give you links so you can put the portfolios into your account. One thing you have to do at Stock Charts is you have to be at least an extra member or above. Because if you're a basic member, I think you can only have one chart list. And that's going to be given to you when you first sign up. So I don't think you can download any of our chart lists. You'll be able to look at the charts, but you won't be able to download them. So once you type, if you go in here to May Max Payne and the password link comes up, you can put the password in there and it'll bring you to this page, but you won't be able to save to the chart list. In fact, if you're not a member, you're probably going to see ads, I'm guessing. I'm not even sure, to be honest. But if you're not a member, you can pull it up and see what it might be a call to action for you to become a member at Stock Charts. I don't know. But you should be able to view the charts. But imagine 270 stocks. And whenever you want to go in and look at it, you have to pull this up. It's not in your account. So you have to manually go through every one of these charts and look at them. That would be a pain in the butt. So I think you're kind of getting the gist of, what we're doing here with the portfolios, the big announcement coming tomorrow, all of these chart lists that are available. I think that's probably everything I wanted to go over. I've got my work cut out. I will tell you, members, tomorrow, and we do a daily market report every day. I write one every single day. So here was today's, just to give you a sense. It's not just these chart lists. I give you my market update every single day. Quick executive summary, market outlook, sectors. I was showing how the home builders trying to make a big breakout today, which is really encouraging for the market. Then under the chart list, I give you some stock setups that I think look interesting here. INSG, I actually was buying today this stock along with a lot of others that had been very strong in March and April. This one's pulled back a little bit, had a rough day today, but I like the way it closed, came off the lows. But I think this is one that I think looks pretty good holding in. I think it closed above the support line here. Went down to 940 or something, I believe, intraday, and then came back up. But I'll give you stocks that I think look interesting. MPWR, Monolithic Power, show you what I look at. Price support came right down to price support, right near that 20-day moving average, and then bounced, reversed right off of it, which was nice. Look at the AD line, continuing to rise. These are the things that we're going to continue to point out. Tell you a little bit about the earnings reports coming out, so you're at least aware of those, economic reports. Really comprehensive service, I believe. So if you're interested and you're over at earningsbeats.com, click on what's called there the webinar special. It's really our spring special. Normally, once your trial expires, and again, if you want to sign up for a trial, it's free. You'll pay $7, but the $7 will be refunded to you in 5 to 10 business days. So net out-of-pocket cost is going to be $0. If you don't like our service for whatever reason during the month, call or just write into us, support at earningsbeats.com and cancel. Just say you want to cancel. We'll take care of it for you. We will. I promise you, you will be canceled. But if you like the service and you don't cancel, you'll automatically be charged $97 a month going forward. So you need to come, let us know that you want the annual deal. And the annual deal, instead of paying $97 a month, which is $11.64, normally we have an annual special of $697. That's what we normally have, which is roughly I don't know if that's like 7 months of $97, maybe just a little bit more than that. So essentially, just normally you're going to get 5 months free. Well, we're going to add in 2 more months during the spring special. So instead of 12 months for $697, you'll get 14 months. There's your 2-month membership bonus. So now you're going to get 14 months for $697, which works out to less than $50 a month. You won't have to worry about it for 14 months. You'll be able to get that industry group relative strength chart list that I talked about as an annual member. We'll make sure you get that. And then you can just kind of see, I mean, we have so many webinars. Haven't even talked to you about the fact we've been doing these war room sessions. Now we're probably not going to continue doing these, but throughout the pandemic and the stay-at-home orders and everything, while everybody was at home, camped out at home, we decided to start doing Saturday webinars. I'm in South Carolina. We've now opened things up again, and quite honestly, I want to get out and play some golf on the weekends. So we're going to probably stop doing that as of this Saturday. It'll probably be this one coming up will be the last one we do. But we still do occasionally. In the past, we've done Friday webinars, so we may, continue doing those from time to time. But you can see what you get. I mean, the value of this service, I think, is just crazy. I've had portfolio managers write into us to tell me, they've never seen anything quite like this in terms of value. I had one I wrote about in a blog article, had a portfolio manager write in and say that he essentially gave up on Bloomberg Terminal, or what is it, Bloomberg Terminal or Bloomberg, whatever, their platform that they charge whatever for. And he is using just earnings beats and stock charts. And I think it's a powerful combination. But give it a try. If you're not already checking out the service, if you sign up for a trial, you can come in tomorrow for our regular webinar, even if you don't pay us anything down the road and you decide, the service isn't for you, you'll still be part of this webinar tomorrow, and you'll be able to get our portfolios, and then you'll have some time to check out the service. The only thing you'll need to do is when this spring special ends, which is May 23rd, which is Saturday, you'll need to make a decision. If you decide that you like it and you want to take us up on this membership special for a year, we will still give you the rest of your free trial. So it's not like we're going to, not let you have the rest of your free trial. So if you were to sign up today, which is May 18th, you would go till June 17th, and then we would tack on 14 months from there. So you'll still get full benefit of your trial. That question comes up from time to time, so I just wanted to make sure I address that. But I think it's a great value. I think we give our members a lot. I cannot remember one single email, not one, where I have had anybody write to me and say, you're overpriced, or this isn't a good value. And I think our service speaks for itself. But anyway, that's it. That's what I have for today. Tomorrow's the big day. I am so looking forward to this. This is one of my favorite days of the quarter. A lot of work ahead. So tomorrow's DMR, I'm either not going to do one. Actually, I'll probably write something, probably a quick paragraph, but don't expect much in the DMR tomorrow. I'm going to be swamped trying to get everything ready for these portfolios. But that is it. So, John, I don't know if you had anything to add.
No, fantastic. We'll you get this recording out, tonight, hopefully, or as soon as possible. But I'll just say one thing: if you're somebody that's not a member right now, you can sign up for the $7 trial. You get $7 back, so it's free, basically for 30 days. Take advantage of that annual membership. It just doesn't get any better than that. And tomorrow's going to be awesome. Look forward to it.
Yeah, and I was just showing, if you go into the homepage, you'll see this big button, Join Today. That's how you want to get through. Just go there, kind of get an idea pretty quickly of what we offer. And we've been changing things so rapidly. I mean, I'm not even sure that this covers everything that we give our members. But then click on the Join Today and just fill out the information. And like I said, it'll take us about 5 to 10 days to refund the $7. But trust me, you will get refunded. So net, it'll cost you $0, and you can check out what we have to offer. I think you'll enjoy it. So that's it. Everybody have a great day. And tomorrow, be back in the morning over at Stock Charts TV with the next Trading Places Live. Everybody have a great night. Stay safe. And, of course, happy trading.